This episode is sponsored by Property Filter. Find great deals faster.
Hello and welcome to the Financial Freedom Podcast, sponsored by us at Property Portfolio Building. This podcast is designed by real people on their journey to achieving financial freedom, and we'll focus on people who've either already attained it, who are joining us on that journey, or maybe a specialist topic that can help you build your technical knowledge to achieving and maintaining that financial freedom. We hope you enjoy it. Hi folks, and welcome back to the Financial Freedom Podcast. Today on the episode, we're going to be talking about the property market outlook for 2026. This will be one of our technical episodes, so it will be myself and Tim going through our views and opinions. And just to start, this is an opinion, of course. Nobody can predict the future. And we're going to hopefully get to grips with some things that are affecting property and economy in general, and where we think the best opportunities might lie for people who are looking to progress their property journeys. So welcome back, Tim.
Thanks very much. Great to be back and back in the country, because last filming session I wasn't even involved. How did that go?
Yeah, it went well. Yeah, absolutely. We'll look forward to those episodes. Haven't actually been released at the time of recording either, so needed some editing. But it was good. I think we need to address the elephant in the room as well.
What's that?
It's Dress Down Friday.
Yeah.
Do you want to tell me why are we in Dress Down?
My branded clothes are degrading a bit, so I had to order some new ones. So
okay. I just felt like maybe it was you wanted a more casual view on the podcast. I didn't know. Yeah, right. Okay. So basically, you've been washing your clothes too hard. Is that what you're saying?
Well, maybe our washing machine's too hard or whatever, but the branding badges come off.
All right. There you go.
New ones. So.
All right. Yeah. Because I was going to say, we're not exactly the height of fashion. We've gone for a black and a grey t-shirt.
Well, I'm just going the Stephen Bartlett style of just the plain black casual.
That's
what he wears.
So it says.
That's what I went for.
Yeah, when you look at my wardrobe versus my wife's, I buy 6 t-shirts in a packet. And my wife, so her wardrobe is all sorts of colours. Anyway, So moving on to things that are more important. So I'll crack on with a first question, which we're going to talk more generally. That's all right. So we'll get into the property specific points. But so January 2026, what are your thoughts on the UK economy and potential effects on property right here, right now?
Yeah, so I don't really want to be negative because it's that's not the theme of the podcast. We're the Financial Freedom Podcast, stuff like that. So in general, I'd just say it's not in the best state at the moment. I would say holistically, but it also could be much worse. Is a way to put it. I would say. So I think it's been pretty resilient. So if you took obviously the pandemic and the issues with stimulus packages and and all those sort of things, which resulted in high inflation and high costs and energy costs going up, all these sort of things. There's been quite a few holistic challenges that have been, thrown at the economy. I think it's sort of been pretty resilient, but there's just not a huge amount of growth at the moment. It's not booming.
Yeah, the news is quite negative, isn't it? Like employment growth's not there, and
Well, I think the news is a good point actually, just to bring up, because I don't tune into the news.
Yeah,
and this is one of the
headlines.
One of the reasons. Yeah, I'll see a bit on social media and stuff like that. But a great quote that Dan Hill from Property Entrepreneur says all the time is that if you watch the news, you're misinformed. If you don't watch the news, you're uninformed, basically. Yeah. So you could
live somewhere in the middle.
Live somewhere in the middle, basically.
Have your own viewpoints.
Have your own viewpoints, basically. So that be conscious of the news, because obviously
there's some definite
negative things sell a bit better.
Yeah, there's some definite challenges as well. We're at the first 2 years of a political 4-year cycle.
Yeah,
I think the new government have gone hard on some certain things.
Yeah,
and if it's exactly what I would do though, right? So I would go really hard early because I've got 4 years.
Yes.
So I'd go hard in year 1.
So where are we now?
Coming up to, we're mid-year 2.
Mid-year 2, yeah.
So I'd go really hard in year 1. I'd then go see what worked, see what didn't work, and then I'd go soften it in year 2, end of year 2, and then go more back on the political, aren't we great?
So politics is the challenge there in general, because obviously the Labour Party had a manifesto and things like that. Yeah. So they've had to try and stick to some of the key things in that manifesto, which might not be the best things economically. But so I think the other things to look at generally, because obviously we have a lot of investors and property people that tune into this podcast, is that, there's been taxes brought in on businesses and property in general. So that's just made it a bit harder in the economy. So as a result of that, we've seen quite a big exodus of millionaires across the country. I think the stat that I heard is something like 1,000 millionaires per month have been leaving the country to live in, I don't know, places like Dubai, Singapore, Portugal, Australia, places like that, or America.
It's important to recognise as well that the problem with that is they pay way more tax.
Yes.
Like, so the problem is we have two things. We have a percentage tax-based system, and we have a physical pounds in the bank.
Yes.
Right? And those two things are wholly separate. So a percentage of pay wealth versus an actual pounds in the bank, right? So the percentage is always higher on working people than it is on investment people and people who hold wealth. The percentage, the pounds is always weighted on the people who hold the wealth, right? So I think one of the billionaires, as an example, that left recently, his percentage of his tax bill was higher than it was before, but the amount that he paid was significant. And I think the calculation was it would take 450,000 average workers in the UK to pay the same amount of tax as this one person. So that's the big wealth divide. And that's what that is a problem.
There's other key things to look at as well. So wealthy people, business owners and things like that, obviously, they pay other taxes like VAT, maybe higher council tax for properties and business rates and all these other things that are also paid. So even though their personal tax may be managed better than the average person that pays, per month with their salary, holistically, the amount of economic activity that results in tax, is much, much higher as well. So if those people leave...
The public spend promises have gone up as well, which is why businesses are struggling more than you would think, because the increase in business rates, the increase in employment, national insurance, all of those things combined, especially in hospitality, VAT, things are costing more, therefore they're charging more. VAT is more. Do you know what I mean? Because
that's resulted in inflation as well. But what I would say as well is the people in the last, say, 4 or 5 years that have bought assets, the economy's done fairly well for them. So if you think you've bought, you bought property, you bought gold, silver, you've invested in stocks and shares, maybe crypto as well and things like that. They've all gone up substantially in the last 5 years.
Inflation, right?
Yeah, generally, inflation's a big factor because of it. But that's a way to protect the issues of inflation, and also inflation squashes debt, which we've talked about before on this podcast.
It's a good point too, because it's not something that we just move on from that point, actually, because I think this point is both on the property outlook and why it matters. So inflation erodes debt, right? So in my opinion, and obviously it's not just my opinion, that's how it works. So if you have a mortgage, say you have a £200,000 property with a £100,000 mortgage, let's use simple numbers. That your loan to value is 50%, right? If in 10 years' time that property price has doubled, or even gone up by another £100,000, your property, your loan to value, if you kept it the same, it's gone down to 33%.
Yes,
from 200,000 to 300,000, 33%. So that's how inflation erodes debt. In principle, a very basic example of that, of course.
And that's exactly right, because my first few properties were bought in like 2018, 2019 in the UK. So we're talking 6, 7, 8 years now, or whatever. And naturally, the loan to value on those, even just by keeping the mortgage the same, has dropped 40 to 50%, whereas initially it was 75% or whatever. So that's just what time does.
Yeah, and the counterbalance to that is when there is a market correction due to overinflation or maybe prices moving ahead of that inflationary price, and there's a market correction, it then brings that back towards the debt line. So if you were in a big property world, that can be and you've got very expensive properties, that can be very big in terms of like a percentage. So if you've got a £1 million property that becomes a £2 million property, and you've got £500,000 of debt, and then it comes back to a £1 million property, you've basically gone backwards on that significantly, both on a sum and on the amount of debt you hold against the loan to value, effectively. So those things are actually active, and we'll probably touch on that in a little while. We're talking about the property market, that top level.
So I suppose to round out the wider economy, so I think it's generally got a bit harder for business and investors.
It feels harder, doesn't it?
Yeah.
As a business owner, government intervention.
Government intervention and regulation, all those sort of things. So if you took property as an example, like the Renters' Rights Act as an example, that's made it harder for landlords, in the economy and those sort of things.
Costs, so agencies and things like that are reliant on manpower.
Yes.
They're having to look at their cost base because they're having to pay more NI. The cost of VAT, suppliers to that may do gas and electric, the cost of their costs, because they're having to put their costs up due to, if they have an office, business rates are going up and employment costs going up. So that is a real problem.
And then the result of that is, so if you got there's a big middle class in this country. So, salaries, your wages have gone up a little bit, but the gap between, say, wages and owning a property's got bigger. That divide keeps getting bigger and bigger.
Yeah.
And then disposable income for most of the population, it's just got tighter. There's less of it, isn't it?
Because I saw an absolutely mad stat, which was the equivalent salary today of £20,000 in 1980 would be £100,000.
Yeah, exactly.
From a property affordability.
That's a good
and
example.
I don't mean today. I mean then.
Yeah.
From an affordability perspective versus a property price.
Yeah.
You would have had to have had 100 grand in 1980 to have the same affordability as you do.
Yeah, and then what that means is it's
26.
harder. The entry level to own a property or become a property investor is harder. So there's, over time it's going to become more and more valuable. So hence why, we say you should invest in it.
But there are huge benefits to the UK economy at the same time.
Yeah, 100%. Yeah, there's big industries.
There's big opportunities here as well.
Well, I think the tech market, as an example, I think the UK's the number 3 in the world still at the moment. So if you think AI and tech and everything like that, finance as well is one of the highest. So definitely tech, finance, and obviously the education space, because we've still got some of the best universities in the world. I can't remember how many, might be 3 in the top 10 or something like that.
Although I did read that international student applications are down. I don't know what the principle is behind that, but that is obviously that's a concern from future skill gap.
Yeah,
right? Because we do need these people to fill the gaps of skills that British people don't fill.
Yeah, 100%. Yeah, so it must be something with some other countries and what they're doing to get students across.
Yeah, to be potentially more attractive or whatever.
Yeah. So I think, flipping back to yourself then, is there anything else we've missed on the general outlook of the economy that you add to that?
No, it's a tough market. It's been a tough market. It continues to be a tough market in general, in terms of, like, obviously we're business owners as well, but we are seeing some signs of relief. I mean, the thing that was most affected, obviously we had COVID, and then we had the sad Ukrainian war with Russia, which, obviously gas prices and wholesale prices were really jumped.
Energy prices generally.
Hugely.
Yeah.
And that drives everything, by the way. It does drive everything because everybody uses it.
100%. Energy prices are key for
so those things COVID obviously is now gone away a little bit, but the effect of it is still being felt, and the Ukrainian thing is still ongoing. I think the big risk is the global economic positioning.
Yeah.
The questions being raised of certain global watchdogs, if you like the WHO, like NATO, those types of things, and the use of tariffs, certainly coming out of some of the major powers to try and restrict and negotiate in a hard way. It's obviously macroeconomics. So how that will affect and trickle down to you and I or the person on the street is not yet known. But whenever something that fundamental happens, you can expect that the certain
we're a world economy, aren't we? At the end of the day, so anything that the US brings in will have
there's an inflationary risk.
Yeah,
along those things, because we've seen it on time and time again. And because we're not yet out of it, we're on sort of like the down slope from the last two, which is we're not yet at the where inflation should be. And the inflationary risk, what it means, it would be you just coming out of what is effectively a high level of inflation, and then probably going to have another small peak towards the end.
So those major events could have an effect.
Yeah, they have the biggest event on inflation for sure.
Yeah, 100%. So back to what you were asking before, and how does this translate to the state of the property market in general? So one of my favorite quotes from Warren Buffett, actually. So, be fearful when others are greedy, and greedy when others are fearful. So I'd say at the moment in property, generally, people are fearful, aren't they?
Yeah.
So what does that tell you?
Be greedy, right?
You need to be greedy. You need to be buying stuff because everyone's running for the hills. They're worried about the market. They're worried about Renters' Rights Acts. They're worried about inflationary costs and all these sort of things.
Yeah.
So because of that, you should be buying. You should be greedy now. The market's relatively stagnant at the moment. From a growth perspective.
Yeah.
There's also a big lack of competition in the property investor space. So the stat I heard a couple of weeks ago was only 4% of existing landlords are looking to buy a new property or increase their portfolio, which is staggeringly small, isn't it? Considering.
Did you get asked?
Huh?
I didn't get asked.
Asked what?
Whether I was increasing or decreasing. So what is the percentage? That always a little bit like.
I think there was some sort of survey done.
So if you
there was a good percentage that were leaving the market. That was I think I can't remember. It was like 20 to 30% were looking to leave the market.
So if you look at the things that affect directly to determine where that market positioning is. So about 6 years ago, I think it was George Osborne brought in Section 24 tax, which was that if you own properties in your own name, you were no longer able to offset mortgage,
the finance cost,
right? The final cost of finance. So if you're a property investor and you've got a mortgage, that now forms part. You have to pay the debt over the tax over that mortgage. So if you're profitable, then you would have to pay the tax. So if you've got £1,000 rent and a £500 mortgage, you're paying tax on £1,000 rent, not the £500 gap. That's the difference. So if it's a 30% tax you pay, you're paying £300, not 150, as an example. So So with all of the costs combined, you then need to be looking at your LTV to be really low to make you profitable. So that has been rolled in, staged in as well. So it's now last year was the first full effect of that, which has driven it. So that is the number one driver, in my opinion. And if you think about it, if you're a landlord and you would what is the standard now, which is buying in a limited company whenever the buy-to-let mortgages first came out, there wasn't no one for a limited company. They were all in your own personal name. So most people would be buying in that premise. The problem is it's declaration of those incomes as well. One of the reasons that they determined that this was a good idea was that they would recognize that more corporate landlords would be formed, which is a company of various sizes, from one property owning companies to the big Black Rocks of this world. But because they are declarable and they have to be accounted for on an annual basis, there'd be no, pay me your rent in cash, and then I'll just declare half of that.
There's much more control of
there is
the accounting. And
I'm not saying people were doing that, of course. Definitely didn't pay cash in hand for my landlords in the past. But that is one of the reasons. So what you're facing now is you're facing people who may have held property for 10 years and above, who may have bought it at a much cheaper rate, who may have very low LTVs and have been sat back and just enjoying cash flow for a while, who no longer have cash flow.
But do you know what the government could have done to sort that problem? They could have just said, right, if you own a property in your own name, we'd prefer it to be in a company structure.
We'll let you incorporate.
Yeah, we'll just let you incorporate and not have to pay any.
Yeah, come up with a different regime for that.
Because the issue at the moment is people, to transfer from personal name to company, you pretty much have to pay stamp duty and stuff.
I don't know. I think there is something, but I don't know.
It's not straightforward though, is it?
It's not straightforward.
If they made it straightforward, it's literally just like transferring it across. There's a little bit of legal cost or whatever.
Yeah, but you've also got the mortgage debt going from a personal to a company. Yeah, there's loads and loads of nuances, isn't there? In terms of, I'm sure there's ways and means.
Yeah, that's true.
So yeah, there's all sorts of issues along those.
So there's
still all sorts of management techniques.
So there's still people that are going, that have that Section 24s that are like, right, I'm getting out of the market, I'm selling. So
secondly to that is then if you're that same person and you've always been, most of the people who you hear haven't kept my rent up with the market, as an example, I'm just happy, no voice, same tenant for 5 years. Those people are being targeted, in my opinion, through the new Renters' Rights Act, because all of a sudden you've gone from a very easy environment to a very regulated environment. And if you've not kept your rent up to market rate, then by April, is it May?
I think it comes.
So by May 1, you can only do certain things. So you wouldn't be able to massively jump without challenge, as an example. So, and there's also new regulations, which is, if you wanted to take your property back for sale, as an example, you have to give a 4-month notice. You then have to sell it within, you can't then rent it out for another 12 months. All of these regulations coming in, and you've also got Section 24. And I've held this, and I've had the 10 years worth of inflationary capital growth. I'll be looking at it practically going, well, I don't need the hassle. I've got a lot of capital here. I'm earning I'm earning less than a couple of £100 a month right now on cash flow. Why am I retaining all this value? Let's sell it. So I think that landlords selling who are in that scenario, that's the number one thing I think that's going to come to market. It's in their own name, worried about Renters' Rights Bill, not making a great deal on cash flow. Can't really sustain a couple of months if you've got a mortgage, because
this is your 20 to 30% of the market range. And a lot of people are in that percentage that want to exit. So I think on the flip side to that as well, every single day, every single week, month, there's people that leave high school, that leave university to go to work, and all those sort of things. So the demand is constantly there. There's enough population growth still and all these sort of things to push up the demand for these sort of properties and the rental sector generally. The supply is dramatically reduce.
Yeah, and
reducing
there's
quite
places
quickly.
because obviously so you can sell tenanted, but it's more difficult.
Yeah.
Vacant possession is the easiest way to sell your property because then you're
Yeah.
opening up to all markets.
Yeah, yeah.
A tenanted property is only then the transfer of wealth to another investor, and the transfer of wealth, I think, going back to your point from Warren Buffett,
Yeah.
is being greedy. Is that there is if you have a limited company, I think there's a huge transfer of wealth opportunity this year. Because if all I care about is unlocking some of my equity, I'm more likely to sell not at a premium.
Yeah.
If that makes sense.
Yeah.
So I think there'll be some market stagnation at certain levels, and I think it'll be that 2 to 3 bed property levels.
Yeah.
Because in terms of property prices, I think it will stagnate slightly. And the reason being is just because of the supply coming on the market for sale.
More stuff getting sold. Yeah.
More stuff available to be bought.
Yeah.
So I think that will come on the market and it will stagnate a little bit. I don't think that stagnation will necessarily help the levels above the 4 and 5 bed properties and the bigger properties, which I think are already under pressure this year.
Yeah, agreed.
So I think what will happen based on those things. So if you think about the biggest shift in markets right now is the North is outstripping the growth on property prices than the South on a percentage basis, mainly because there's more headroom, versus, a 500 grand property versus a 500 grand property.
Yeah. So the gap that we talked about earlier between, say, wages and property prices. Obviously, in London, that's sort of the biggest gap, isn't it, to a certain extent? So, up north, that's much less, which means that there's more headroom to move and all those sort of things.
Yeah, there's also the headroom for properties to grow in terms of so if you excluding London as its own bubble, which we'll talk about. I'll touch on basically.
Yeah,
we'll touch on London now. London prices have basically cooled.
Yeah,
it's probably the biggest percentage drop I think is what I saw. In terms of actual value of property, I would suggest that that's more to do with the overinflatory London effect than it is to anything else in the market. However, outside of there, I mean, even in the north, we're seeing this middle band to upper band stagnation to a degree. So I've tried selling my own property as an example at the price that it's reasonably worth. I've not pushed it too high. I've not pushed it too low. It's been on the market for a while. It's not that it's not getting... There's just nobody buying at that level at the moment. And the reason for that is there's numerous reasons. Obviously, there's no incentives to buy right now in practice.
Yeah, also, I think if you took like late 2025, interest rates had come down a little bit, but not a lot. There was also people were waiting because of the budget announcements and things like that.
Yeah.
So I do think...
Uncertainty is not helpful.
Uncertainty, and, worry and all those sort of things. So I do think there's a bit of like pent-up demand that people that would be moving to buy those sort of properties have waited a bit. At some point, maybe in the spring this year, that might bounce back a little bit. You get more activity and all those sort of things. But
yes, I think the property market has cooled. That's why the Savills of who are the number one trade indicator for the UK.
Yeah,
they've certainly cooled their pricing and their outlooks and what's happened in the last 12 months. And I think that's going to continue for a period of time. Depending on what happens with inflation and going back to that global economics and inflation, depending on what happens there, I think what we need to see is financial incentive to get the property markets moving. Because if we're going back to percentages versus tax again, actual amounts again, so it's more expensive to buy a property due to stamp duties and lower thresholds. There's some incentives for first-time buyers, but the middle market is more expensive. And then it's also very much more expensive for property investors because they pay a higher premium now in stamp duties and so on and so forth. And the interest rates are still reasonably high.
Yeah.
So if you wanted to get a step up on your ladder to that headroom between your wage and the next level is very high, you might be able to just get there, but the cash flow.
In saying that, has dropped. I think it spiked post-pandemic. I think the base rate was 5.25%. It's now at 3.75% on recording of this podcast. So it has dropped 1.5%. So if you think the affordability in that range, it has got better.
Yeah.
We'll talk about it in a bit, but we may see a little bit of a drop this year, depending what happens as well.
Yeah, if it comes down to the 3.25s or the 3s and then the main street banks are starting to produce products which are accessible for general people at the sub 4 or sub 4% range. All of a sudden, I think it unlocks that market because my first mortgage, even in a good market, was 3.99% as an example.
Yeah.
So if we're back in those ranges, all of a sudden that headroom affordability factor is there because it's the percentage of affordability above your gross wage.
And you talked about it a little bit before as well, but obviously there's things that the government can look at like stamp duty rates and things like that and incentives to help boost them up, which as soon as they tweak things like that, it'll boost the market.
Like first time buyer stamp duty holidays and just even brought the threshold back to 250 rather than 125 and then moved all the thresholds up. where the percentage leverage is. It doesn't even, not even for property investors, just for general regular people. I think that would be a very, very smart move. But it depends, really. It depends. There might be a very, behind the scenes, we need to cool the property market. There might be a play right now.
Yeah.
They might be saying, oh, well, and then next year they might say we've been able to reduce property prices, wholesale property prices, to make it more affordable. And now with new interest rates, it is, and now we're going to incentivize it again. So now we're going to do the stamp duty to that. And then we'll see this coiled spring effect.
Yeah. Right? And then it will boost up after that.
Because there's so much.
I mean, they could say in like inflationary terms, they have cooled it a bit anyway with the last few years and interest rates going up and stamp duty going up and all those sort of things. So they could say that already, couldn't they?
I think it's interesting the values have held in the main outside of London. I think that's very interesting.
Well, they've been fairly resilient, haven't they? But if they've held in real terms, they've dropped a bit out with inflation. Which is relatively unusual. So that means that I think
I think that 2022 boom, I think that was the biggest.
Really jumped in.
It was massive, and I think that's cool, and that's why we're now seeing this.
And that's why I was saying, like, as an investor in this country, if you've got assets and you've had them for 5 years, you've done really, really well. So even though property prices have cooled the last 2 or 3 years, if you looked at it over a 5-year period, they've gone up 30 or 40%, depending where you are still.
Absolutely. And if you go back to the fact that property prices are dipping below inflation now, that creates this coiled spring effect again. And if incentives are brought in, property prices are going to rise in general. Right? And you're going to get the coiled spring on that. So if you're a smart investor and you're thinking, well, going back to the Warren Buffett quote of being greedy when others are fearful, and knowing and kind of thinking, well, I think this wealth transfer is a real thing because of Section 24, because of the Renters' Rights Bill, because of those things. Because once the Renters' Rights Bill's been in for 6 months, things will be understood and cooled, right, and adjusted and tweaked, and we'll find it normally, you'd expect a happy balance. So all of those things combined, it's like, well, you could probably buy in a below inflation market at a potential discount for somebody who just wants to exit because they've got the Section 24 on their Renters' Rights Bill on their mind. And then by this time next year, you could benefit from that capital growth because there is potentially a coiled spring effect that will be incentivized either late 26 due to reducing interest rates or probably into 27, maybe in the October budget or by the next year budget, which is an actual incentive based on stamp duties and so on and so forth, which probably come in to stimulate the market.
Yeah, and if you're worried about your position in the economy in the UK generally, just become the top 2%. I know it sounds easy, but the top 2% roughly, they earn 100 grand a year and their net worth is £1 million, something like that. That's the top 2%. So, if you get...
Is that right? Is that top 2%, is it?
Yeah.
Is it?
It's even like 1.5 or something when I researched it.
Wow.
Yeah, you would have thought like 5-10% or something like that, but it's not.
I think I don't think it's the salary. I think it's the net. I think it's the asset value, isn't it?
I think it's the combination of the asset value and the earnings, whether it's business or wage or whatever. But yeah, so obviously opportunity in property gets you to be within that range. And then on top of that, you get, the growth that outstrips inflation. Whereas if you're just, earning from a salary, it's not really going to get easier for you, is it? Because of inflation and the gap between owning your own home and the wage and all those sort of things and the cost of living and all those sort of things.
Yeah, and I think it's really important to note that there probably is going to be a rent rise this year for 2 reasons. The first one being, if you're staying in the market and you've been a little bit kinder to your tenants in the past, that's likely not going to be, you're likely going to want to adjust that before the 1st of May. So I think that alone is going to increase the average amount of rent being paid by per head by a tenant. The 5-6 million tenant renters or whatever. So there's that one, and then there's the like you said, it's so if you're thinking, the thinking is always, well, if landlords are selling, there'll be more supply in the market. Well, no, it's the same supply. There's just less to rent. The number of renters is the same because not everybody's ready to buy, right?
Yeah, well, the number of renters increases, doesn't it,
over time.
Yeah.
So, and also, I do think that market is going to, like we said, it's going to be cool and stagnant for a while. So you're probably going to have a lot of empty properties for sale.
As
well.
So those things are going to push rent up. But what doesn't change is it becomes less affordable because rent's going up higher. Wages aren't going to jump as quickly, which means like the percentage of rent paid to disposable income. I can't remember.
I think it's going to be really hard to rent.
It's something at the moment around about 30%. But when that pushes higher, the challenge is going to be the market saying the rent is this, but the affordability for that.
And that's when arrears occur. And
people that can jump into that range isn't going to move as quickly. And that's going to be the challenge.
Stop the podcast now. This episode is sponsored by Property Filter. Property Filter is the #1 property tool for today's property professional. It brings in all the data points and sources from all the property portals and auction sites into one convenient place. Then you have the option to overlay all the clever strategies found in the Property Filter blueprint to find motivated sellers faster. Now, we use it on a daily basis. It saves us over 80% of our time when looking for properties. And if that sounds like something that you want in your lives, please go to register.property-filter.co.uk/PPB, which is the discount code for this podcast. You will get 2 weeks free and a discount on your first month. That's it from me. Back to the podcast.
There are huge things coming down the chain as well. You know, the reduction in some job functions due to technology improvements. I mean, I know people are talking about AI replacing the world. I don't think we'll get.
No, but there will be transitions of
yeah
jobs and roles and all those sort of things.
Then they were talking about minimum income rather than a universal credit and things like that I think will come out in the future. But I don't think that's this year. You know, I don't think that's going to have a material effect on this year's property economy. I think what we've already discussed is going to have more of a material effect of landlords wanting to sell, wanting vacant possession. That's taking a lot more time than they would like. You know, I think the property market being stagnant is unhelpful.
But as an investor, so you want to be stricter with your vetting process and affordability checks and all those sort of things. So you want thorough checks for those things.
And it's also harder and more risky now to do some of the cash flow strategies, both from a service accommodation perspective and a HMO perspective. Because regulation in HMOs has increased. You know, we've seen it in Greater Manchester, Article 4 directions coming in overnight, catching property owners mid-conversion. We've got clients ourselves who've been caught mid-conversion that we're now battling with the planning offices to get those through to completion. It's not exclusive. We've seen it in the southeast. We've seen it in further north of us, and I think that's going to add risk. And I think people are going to know that's going to be a noticeable.
So it adds risk, and what that means is it's an extra barrier to entry for an investor to do those sort of projects. And so what that puts pressures on supply again that we're talking about. So there's less people converting houses to new HMOs as examples, or commercial property to HMOs or flats, etc. So that market will get more pressure because, like I said before, the demand keeps coming in the market every day, but the new supply won't be.
And the landlords wanting to sell in that space is the same as the landlords wanting to sell in other spaces if you've got it in your own personal name. You know, so there's an element of that. So there'll be some HMOs coming, but what I think is going to happen there is it's going to crystallize a lot of the existing HMO products, going to slow the supply increase, and therefore we have seen larger supply increase, which has increased yields. So yields that were 11.5% in 2022 are now 12.5% in our areas.
You're talking about as from a valuation.
From a valuation.
And that's the simple maths for that is because the costs of everything in 2022 for, say, the landlord were lower. So if you talk like energy bills, as an example, even like council tax has gone up. The interest rates might have jumped up in that period as well. So obviously rents have gone up as well, but depending on the rate of the rent as to how much cash flow you can make as a result, which is putting pressure on in the yield valuations.
Yeah, and the yields have gone up. So the yields have gone up slightly, and if you're thinking about things, good, that's a good thing. It's good from a cash flow perspective. It's not good from a valuation perspective because, you know, the lower the yield percentage, the higher the value per rent.
Yeah, and what that means is roughly something that was worth 350 12 months ago is still worth 350 or something like that.
But you're getting more rent.
Yeah, but you're getting more rent. Yeah, that which means the yields are.
So those yield, I think what will happen is because of that crystallization effect, the sales values of those HMOs will go up.
Yes.
So that yield will recompress back down to
agree.
Where it is now by another.
Because the properties will just become more and more valuable because
no one's doing
there's less of them.
Yeah, there's less of them. You can't do it.
Yeah.
So I think that's coming down the chain. So well done to anybody who's got in early. Yeah. You know, it's very, it's
get in now.
Get in now and start, take your plunge or whatever. So so that's my view is that there's going to be slightly cheaper properties than this year than next year from a capital growth perspective because of all the things we talked about in terms of we're currently under inflation from a house price growth. Landlords might be willing to sell at a discount, yada yada, those types of things. Interest rates are going to hopefully come down another 0.5%.
Right, so let's move on to predictions then.
Yeah,
so if you're guns ahead,
yep.
What's your prediction on inflation? Yep. So as of recording today, I think the inflation rate is at, say, 3.4%, I believe. Interest rates, the Bank of England's at 3.75% currently. So I just want to get your take on that. And then, rent, will price go up or down, which was kind of talked about. And then house prices, what do you think will happen over this year?
2026.
Yeah, 2026.
Yeah, okay.
So we get to December 2026.
Should we take them one at a time?
Yeah.
What's number one?
Inflation rate. What do you think, sir?
Inflation rate, I think it's going to go up. I don't think it's going to go up in the same way that COVID's going to go up. I think we'll see a dip in the next quarter. I think it's going to rise again due to the current political climate. I think that's going to have the biggest effect on inflation. I don't want to name him because I don't want to get political, so I don't want to use the word.
So cost of business will force up inflation again.
Yeah, the cost of doing business internationally certainly is going to rise. I think obviously we're already seeing it with the consequences of Brexit and the consequences of tariffs and so on and so forth. So I think those things are going to go up slightly. I think cost of energy is going to stay the same, so I don't think it'll rise as heavy unless there is a significant
cost of
change.
energy is a big key, because if that can come down for various reasons, that will help inflation come down.
I think
it affects everything, doesn't it?
I think the cost of doing business in general is going to go up, which is going to push the inflationary prices up, and that's a combination of international and at home. Business rates coming up in April, unless there's a fiscal incentive, to settle that down, which might come.
If we flip back to the original discussion we were talking about the wider UK economy. The other thing that we didn't quite touch on is it doesn't seem to be on the front of the government's mind to push for business growth and really boost the economy.
They don't feel very business friendly, do they?
No, they seem to say it a lot, but they say, oh, we're pro business and we want business growth, whatever.
Growth is what we want, but then we're lower on economy, we're lower on employment.
There's no policies that reflect that talk as such yet. So maybe that will come, but we'll see.
Action is louder than words, certainly.
Exactly. Right. So that's inflation. So, inflation did jump the 3.4%. I think it was 3.2 on the last check or something like that. So it has slightly jumped up. So that reflects maybe what you're saying at the moment.
Yeah, potentially. I think that's
maybe by the end of the year. So my thing is maybe by the end of the year, it might push back towards the 3 or something.
I think it'll get towards the 4 mark, and then there'll be some kind of something.
Adjustment.
They'll have to do something.
Yeah, but it's going to hover, pending major events in the world and all these sort of things.
And I think that's
going to hover between the 3 and 4%.
I think that's the problem.
Right, interest rates then. So 3.75% at the moment.
Obviously there's the interest rates from the Bank of England perspective are sensitive to inflationary matters, but there's also the fiscal matter of making sure that things are affordable.
Yeah.
And I think that
and to help the economy in general.
Yeah, I think the employment factor is going to reduce the incentive to employ, the incentive to trade. Yeah. I think that's going to outweigh the inflation. So I think it's going to come down by another 2.25 percentage points, so another half a percentage point. I think it will settle probably by the end of the year around the 3.25. It's only my personal opinion, of course, which I think is the balanced position. Yeah. I think that's a very good balanced position.
Yeah, so maybe a 0.5% drop across the year or something.
Yeah, across the year. Two more drops across the year. And then it'll probably stay there. I think. I don't think there'll be anything that they could do to reduce it further. I don't think we're ever going to see
it all, like you said, your point about unemployment and things like that, and major events that we can't quite see that happen around the world, they can have more of an effect. So they're a little bit unforeseen at the moment. Yeah. We can't really see that far ahead in a way.
I don't really want to get into bonds and technical points and stuff like that, but there's certainly the three things that we can see are obviously employment's down, your trading's down, and
so according to ChatGPT, I had that unemployment's around about 5% or something at the moment. But the figure it gave me as well was something like 25% of people that could be working aren't working or something like that. And I think that relates back to the welfare state at the moment. It's quite a big welfare state in the country at the moment.
Well, that's of working age people.
Yeah,
right.
That's right. Yeah.
Yeah. So that's working age people. There's 1 in 2 that are funded by the state.
Yeah, across the whole
people.
Yeah.
Which is that's too much.
Yes.
And it is literally a 5% swing that changes the balance.
Yeah, a few percent makes a difference, doesn't it?
Yeah,
in that circumstance, obviously.
Yeah.
Because that's a few percent is a lot of people back working in the market.
And the problem with that is, obviously, they've also increased some public spend. So you're getting less money in through employment. More people are more gainfully employed is the political line, which means salaries in general have gone up.
Yeah.
But employment has also gone down, so unemployment has gone up. Across the board, and 1 in 2 people. I think there's that 1 in 2.
So I think the other factor there is, because of the cost of national insurance and wage increases, like minimum wage increase and all these sort of things, and obviously we live in a global economy, and because of AI and tech and everything like that, I think a lot of businesses have gone, right, well, with certain jobs I can just employ someone abroad that can do that at a better rate.
Yeah.
Possibly more efficiently.
Yeah, I can outsource.
Obviously, we've got some excellent international workers in the Philippines, places like that.
And they're world class, by the way.
And they're absolutely world class. Unbelievable the excellence of their work. So I think a lot of other businesses are doing the same sort of thing, which obviously means that
there's no incentive not to do.
Yeah, there's no incentive not to do it. Like why would we pay double for someone here? That's
if I've got a task that can be done from home, and I can do 1 or 2 things. I can look at an AI solution, or I can look at somebody who can work from home anywhere in the world.
Yeah,
because we're a global business, we're a global thing now.
Yeah,
right.
Yeah, 100%.
Okay.
So that's that, right? So I think rent prices we've touched on already, but if you had to put a percentage across, say, the Northwest,
percentage points, isn't it? Percentage points are different, are very difficult to do. I think we're going to see ahead of inflation rent at some point this year. I think that's going to help drive.
Yeah, so if you took inflation's at 3 or 4%,
yeah,
you know, rent could easily go up 5 to 10%.
I think 10 would be a lot, but 5%. I think it will go ahead of inflation.
You say that, but it's very possible in where we are in, you know, Greater Manchester.
Yeah, I think nationally, I think that's going to be strong. But I think it will get ahead of inflation, and that will drag the inflationary points up, and I think that's going to be part of it.
That will be a big part of it.
Yeah, and I think that's the coil. I think that's the counter-intuitive point of this renters' rights bill. I think that's the counter-intuitive point, which is you've punitively punished landlords on the Section 24. Then in the year that they're now having to make considered decisions because of that, you've then brought in the renters' rights bill. It's either really good timing because you're wanting to change that market, or it's poor timing and you haven't considered it properly. You decide.
Yeah. We're not going to go into that too deep, are we?
Yeah.
Right, house prices then. So if you took like the Northwest at the moment, what do you think by the end of 2026?
I think we touched on this sort of that sort of like entry level base. I think that's going to. I think that's the one that's been really okay. You know, we've certainly seen a house that was 170k 3 years ago is now 195k.
Yeah.
I think that's going to cool because of this potential supply coming on the market. Mm-hmm. So we're talking about the basic houses here, the 2-3 bed terraced houses, right? There's less people buying them from an investment point of view because it doesn't work. There's less people buying them from conversions because they don't work. It's too hard, and landlords are selling. So those three things combined, as well as the normal market of people wanting to move.
But I do think there's a lot of people that say last year in a normal market might have bought, but they've held off. So,
yeah, right.
So there's a certain amount of.
So I'm talking about up to, I think, Q4, end of summer this year. I think we're going to see real cooled market in that space, and the knock-on effect of that is it's going to be more difficult to sell, but to sell if you're living in a property because there might be some vacant possession ones coming on the market, right? So what that means is the chain of events. So if you're middle market like I am, so my middle market 4-bed house as an example that I'm trying to sell, I'm going to have less people buying because they can't sell theirs, right? So that's going to remain static, I think, and for the first 6 months. And then you've got the premium market, which has already retracted slightly in certain locations. And I'm seeing, if I could sell my house today, I'd get a much better deal than I believe this time next year. I think once the percentage points comes down and affordability headroom goes up, and that 1.25 to 1.55, 1.45 of net affordability against all costs, because your mortgage rate comes down, is going to create more headroom for affordability. I think that's going to move the market faster than anything else. I think that's what's going to drive the more over above anything else. Employment and that is going to drive.
Yeah. So the other thing you got to think about as well in that discussion is because of like rents. If there's going to be rental growth because of the things we talked about, you know, and the mortgage rates drop down a bit, becomes more affordable, and then wages. Hopefully, there's a bit of growth for wages and things like that. Then people are going to be like, well, I might as well buy. My rent's so high.
Yes,
you know, I might as well buy this.
Yeah, and incentives for that. You've seen it already with the Yorkshire. Was it Yorkshire Building Society saying, "Oh, we'll do a." Might have been Skipton. I don't know. One of them. It was like, we'll do a renters one, which is if you can demonstrate affordability through your rent payments, then we'll happy to lend even without affordability and deposit up to 100% of the value of the property. As long
very good way to look at it, because if you pay your rent consistently without going in arrears, you know, you're going to be able to pay your mortgage.
Yeah. So and good for that. That's a really good incentive. Good incentive.
It's responsible. Absolutely. Makes sense. Yeah. So rent payments should affect credit score as well. That's another thing, isn't it?
Yeah. No, they do. Yeah, absolutely. Yeah. It's harder though because it's not. It doesn't qualify. It can only be a negative.
Yeah, that's what I mean. That's what I mean. At the moment, if you have arrears and you get a CCJ, obviously that will negatively affect your credit score.
Yeah.
And lending in general.
I think that's going to come more as well.
But which obviously is agreed. But like if you can show a consistent track record of paying the rent, like you do, like your phone bill or whatever, that should be a positive for your credit score as well.
Yeah. I don't know why that isn't a thing.
Well, how do they track it?
Because it doesn't class as credit, does it?
Yeah, it's not.
So it's not real credit.
It doesn't count as
credit. Because it's debit, isn't it? You're normally paying in advance for the thing that you get. So yeah, no, it maybe doesn't. Maybe there's a fundamental problem with that.
Yeah.
But you are right, yeah, because if you're paying £1,000 a month rent every month, That's much more than a 50 quid phone bill.
Yeah. So the 50 quid phone bill or whatever affects you massively, but your main cost of rent or whatever doesn't even.
It might even be a manual submission. There might even be something where you can put, maybe the credit companies will allow that. Your rental statement or whatever.
If you want to boost it up, you can request it and say to the agency, like we could send it and say, here's his payment record. And that could boost up your credit ranking. That'd be great.
Some tenants wouldn't be doing that.
Well, but then they don't get the boost, do they? So
yeah, interesting. Yeah, I didn't even think of that. But,
and if they don't give it, maybe because they haven't submitted it, that's a negative.
Yeah. So at the moment, rent can only affect your credit report one way, and that's down.
Yeah.
If you don't pay your rent, you get a charge. Yeah, fair enough. Any points from your side on that? On any of that? I don't think there's. Do you think we're reasonably on the same page?
I think so. Yeah. So if I had to put a prediction on, I think inflation, it's going to hover between that 3 and 4, pending those big events. Interest rates, if I had to put a guess on it, I'd say 0.5% by the end of the year.
Certainly that 0.5% would. I think that is the coil spring effect.
Yeah.
That's going to launch it through the next. And if you can acquire property now.
The caveat to that is if there's some sort of world event or unemployment really drops, it might go more.
Yeah. So I don't see how unemployment could drop, but the world event, I think, is
that could affect it. Yeah, I think rent it could be close to 10%.
Do you think so?
By the end of the year? Yeah.
Yeah, I hope not.
Yeah.
Because and from, like you said, from an affordability point of view.
Yeah, the affordability is the challenge. Like.
And I'm a landlord saying I hope not, right?
Yeah. Well, it's affordability for tenants, and it's the risk of arrears and everything. So it doesn't really work for anyone, does it?
No.
Really, you just want the right, reasonable rent that tenants can afford, but landlords are protected and all these sort of things. That will just be good for the market in general.
Yeah.
So I do think it's going to be a risk for both tenants and landlords because the affordability issue. If it jumps too quickly, the headroom's going to reduce. So
I think a reduction in interest rates will actually cool the rental increases anyway, because you don't need, as a landlord, if you've one of the key things is you've been on a 2% interest rate and then you go to a 5%.
Yeah, if there's more people that are moving out of the rental market into buying,
because you've seen it. We've seen it on one of mine. It was a 2% to 5%, and that's 2.5 times more cost. Just on a simple mortgage.
But the buying, generally, people to buy us, the key thing is obviously your earnings and things like that, but it's the discipline with your finances to get a deposit in place.
Yes.
So, but I know, like, obviously a lot of young people, they can get support from parents and things like that as well. But, I think it's the discipline to save up for the deposit, isn't it?
Yeah, absolutely. Yeah.
I think what we need to follow on to that is what's the opportunity for property investors this year?
Yeah, it's a good one, isn't it?
Outlook.
Well, I think
what would you be? What are you doing, and what would you be doing this year?
Obviously, we have a couple of things that we're doing anyway. So we're looking for to take advantage of because there's still some commercial property out there that's not moving, vacant. You see the high street problems; they're not gone away. Secondary parade.
Well, there's a transition because of the transition in the economy. That's the same transition for commercial properties. There's some buildings that worked for a type of business.
Yeah, that business is now
that business isn't existing anymore,
or work from home,
work from home or whatever. So, but there's still some other types of businesses that could take it.
Yeah,
and there's better ways to asset manage or sweat that commercial property. So there's some good opportunities there.
Yeah, there is, but I think business rates is going to have a massive effect as well. I think the opportunity there for us is obviously we're trying to find probably some good commercial property on the edge of town, which is more to do with how people live today, which is the delivery based thing. I think that's the biggest opportunity in commercial right now is like last mile support, warehousing and delivery and
storage space.
Exactly. But for trade, not necessarily for individuals. I think the housing market, if we're looking at it from a residential perspective, I think that wealth transfers there. So, one of the things that we're doing is when our projects refinance this year is we're looking to potentially take advantage of that by having funds ready to buy single let properties from landlords that just want to sell.
Yeah, jump on deals quickly
and then
have a good amount of liquidity or funds.
And we have seen for the first time, maybe it isn't the first time. I think broker told me off for saying this. We are seeing, quicker refinances.
I had a few messages after our other podcast about no money down because obviously same day refinances come back.
Yeah, and it was after.
Yeah.
So we caveat on that as well that same day refinances are coming back.
It sounds like it's possible if you with certain lenders if you've got a real below market value type deal.
Yeah, I think the deal that's the 90% of the market value or 90% of the purchase, 10% in, and then but lending against the upper value is there. You still got your 10% in. That's been there for a period of time. But the full same day refinance to the 100%, that's the thing. So not buying it, it's the same day refinance. So buying it in some way, refinancing it onto another product.
Yeah, if you're getting it 25% below its true market value. Yeah, that's where it's possible, I believe.
Yeah, and
but anyway, talk to brokers about that and
that LTV percentage position as well. I think the LTVs have been pretty static at 75%. I think if that moves to 80% LTV, I think that really opens up a lot of the markets again, especially for development projects. Because your biggest problem in momentum investing is LTV. That's the biggest without anything else. Because if you've got an LTV of 75% on your refinance, you have to clear 30% uplift in either your deal or your development to get that money back to
it's a big gap.
To move it again to the next one to get
it's a big uplift.
It is a big uplift. Whereas at 80, it reduces obviously to 25, and all of a sudden you're in that. Well, I only need now a development uplift that could be achieved. So I think those things are really things to look out for. The 80% returning, and certainly the same day refinances. But the wealth transfer is the big one for me. It's being able to do good deals with landlords who are just looking to exit the market. I think that's it.
Yeah, and I think a couple of other things to add to it. So just buy assets, buy property. Buy property and wait is a great way to look at it, because that, if you want to get ahead of all these challenges of inflation and wage stagnation, all those sort of things, you just have to get assets.
So if you think that
assets, really.
So we're saying inflation erodes debt, but capital price erodes debt in the same way. And we're saying it's stagnant and under inflation right now, which means that even if inflation is at 4%, if house prices are at 3.4%, if house prices growth is at 0.1% or 0.5%, then what you would expect at some point is that correction to the inflation rate for next year, which if it's still at 3.4%, then you've got 3.4% for next year and this year.
Yeah, and because
you're buying at a 7% discount now,
but also because of bank
against
leverage,
next year.
You get the uplift and the overall value of the property, but you're only putting in part money or low money or whatever compared to the bank. So that multiplies it as well. So I think if you're gonna do a project like development, refurbish, and all these sort of things, I think it's very important that there is a bit understanding the risks involved, getting the right teams, processes in place for that, because that can be risky. Build costs are still going up. We've talked about in other podcasts, increases in utility costs and all those sort of things. So you need to understand that, you can get good returns, a good uplift, but you really need to do it in a professional way. So I think that's really key as well. I actually think the buy-to-let market might bounce back a bit.
Yeah, it's come back.
Because the rents, like we talked about, rental growth. So something a few years ago that was maybe £800 or £900 a month might be more like your £1,200 now. And at the same time, if the interest rates drop to what we said at 3.25%, the headroom for cash flow for those.
You're then looking at, without product fees, 4.5 to 5%. Interest rate. So then, because obviously buy-to-let market is normally for cash flow as well, as capital growth. So you need to be able to pay for the stuff. So a lower interest rate position is going to bring that back, and that's the problem of the market over the last 4 years, and why that hasn't really been a thing, and why the service accommodation HMO market's been so expanding so aggressively, is because that capital has to be put somewhere. But I think the buy-to-let market, especially on that wealth transfer of being able to do a deal with a potential landlord who's received that capital growth over a period of time, might be willing to do a deal.
And the other big advantage is if you've got a good buy-to-let property with a family, whoever that's going to live there for a while, you're not paying the bills like a HMO, and you don't have as much turnover. Tenancy risk is a bit lower.
I think EPC
it's a bit more passive, isn't it? EPC
discounts are there as well, where you can say, listen, it's going to cost me. Rightmove and Zoopla are now showing the on there how much it will be to improve your EPC. So you can use that as a negotiation tactic. But in the reality is, if you've got a good team, those are guesstimations. If you know
add a bit of value there with the EPC and a refurb, and exactly. So I think that's bouncing back quite a bit. So I think that's a
good opportunity right now. I have to say, for that buying property it still carries risk. Obviously it always carries risk, because we don't know what's going to happen in the world. But if you're a betting person, I would say that now would be a really great time to move forward on property.
I think so.
Yeah, good stuff. All right then. Well,
we'll see how that at the end of 2026.
Crying into our tea at the end of the year. So good stuff. Right, thank you once again. If you haven't liked or subscribed on the podcast, please take a moment to do that. If you turn notifications on, you would then be notified of the next episode when it's released. If you've got anything to add to us, or you want to become a guest on the show, please do get in touch. The instructions on how to do that, follow this message. And thank you very much, Tim. And we will catch you on the next one. Bye for now.
Till the next one. Bye bye.
Thank you once again for joining us on the Financial Freedom Podcast, sponsored by us at Property Portfolio Building. If you want to get in touch with us about today's podcast or any of the learning topics that we've gone through today, you can email us at podcast@invest-prop.co.uk or get in touch with us with whichever your social media platform of choice is. If you think you would add value to us as a guest on this podcast, you can please get in touch and let us know what you would be able to talk to us about. Other than that, we wish you well on your financial freedom journeys. And once again, thank you for joining us, and we'll see you on the next one.